Hi and welcome to this video. We're talking about mastering execution under pressure. This is a very specific skill that is relevant to every trader, from beginners right through to seasoned professionals. And the consequences of not mastering this skill are very costly. Today, we're coming at this from a systems perspective and why proactively addressing inconsistent execution under pressure is the one missing piece in every trader's risk management system. I'm Sheehy-Kelly. I'm a high performance and trading psychologist. I've been coaching since 2007 with elite performers across professional sport, finance, and business. And since 2019, I've been exclusively working with traders and hedge fund managers on this specific issue of execution under pressure. My specialities in my career have been performance under pressure and behavior change. And what we're going to cover today is at the intersection of both of these factors. We have three key goals with this webinar. Number one is to explain the science behind why traders violate their trading plan. It's really important to understand the root cause of this so that you can then implement a fix that is actually going to change how you execute under pressure. If you don't actually understand the root cause, you're only applying band-aid solutions. And there's a lot of these out there on the internet. So I want to explain the science of what's happening when you violate your plan, and then also use that science to explain why these surface level solutions won't cut it. Number two, we're making the case for why inconsistent execution demands a risk management approach. A lot of traders wait until they're fully feeling the pain of indiscipline and breaking the rules before they do anything about it. But there's a better way to do this. If you bake this into your risk management approach, you're preemptively and proactively addressing the risk of inconsistent execution. And therefore, you're likely reducing the amount of money that you're ever going to lose because of this issue. Number three, I want to give you a blueprint for how to actually do this in practice. It's one thing to say you should take a risk management approach with inconsistent execution, but that's quite abstract and nebulous. So I want to introduce you to a mental conditioning protocol that I've developed that's science and evidence-based, and it's used by professional traders to improve execution under pressure. But let's ground everything that we're going to talk about in the reality of the cost of inconsistent execution. If you're watching this webinar, I assume that you viscerally felt the cost of inconsistent execution, breaking your rules in discipline. Maybe you've sat down at your trading desk and had a plan and good intentions at the start of the day, and then at the end of the trading day, you look back on your trades and it feels like somebody else took over the steering wheel of your trading. You don't even recognize the person that executed those trades on your behalf. Maybe you FOMO'd into subpar setups. Maybe you stayed in losing trades too long out of hope as a strategy. Or maybe you jumped out of winning trades too soon, leaving money on the table because you just couldn't deal with the anxiety and uncertainty of the market. If you're experiencing this, you're absolutely not alone. But the problem is that one violation on its own might seem minor, but they compound over time, and it's the accumulation of those individual violations that will lead to a big impact on your account and also your overall performance as a trader. So practically speaking, we're talking about avoidable losses. Yes, losing is part of trading, but it's one thing to lose because you executed your plan perfectly and the market went against you. It's another thing to have just blundered your plan and lost money absolutely unnecessarily. Number two, extended drawdowns. You don't recover after the first losing trade, the second losing trade, the second losing day, and the drawdown continues where it should have been nipped in the bud after the first trade. Failure to capitalize on the full expectancy of the trade. So you could be consistently profitable. You're making good money from trading, but you're seeing the massive amount of money that you're leaving on the table because you're never fully capturing the full extent of what you could if you stuck to your strategy and executed according to your plan. If you're somebody who's doing prop firm challenges, maybe you see failed challenge after failed challenge. You're spending so much money on all of these challenges and you're not seeing the return in terms of passing the challenge and then reaping the rewards. Or at the most extreme end of the scale, maybe you're blowing accounts because of these violations. But the impact of inconsistent execution, it's not just contained at the level of the individual trader. If that trader is operating as a professional in a firm or institution, it creates a system-level threat. It increases realized volatility. So now the volatility is not just down to market conditions. There's actually volatility that's being created due to human factors. It amplifies portfolio level drawdowns. So if each individual trader is going into drawdowns that could have been avoided had they been sticking to their plan, and then that scales across every trader on the desk or most of the traders on a desk, that becomes a firm level problem. It restricts capital scaling. If the risk management desk can't trust the traders to execute according to their plan, then they can't allocate the capital that would allow them to really make full use of their strategies. And the implication of that is that it forces risk teams to tighten exposure, meaning that the firm as a whole unit can't fulfill its potential. This is such a widespread problem that there are solutions all over the internet, in books, on YouTube, podcasts, wherever you look for them, you're going to hear advice as to how you can stick to your trading plan under pressure. Some of the most common pieces of advice that you'll hear: follow the process, become a more disciplined trader, remove decision-making with defined rules so you don't have to make any in-the-moment decisions when your emotions are running high, manage your emotions in the moment, or reframe your thoughts. It's not that these solutions are wrong, it's just that none of them actually offer enough depth to explain how do you change your behavior. Changing behaviors is the hardest thing to do. It's very easy to give the guidance as to what should work, but to actually walk someone through the process of rewiring their internal landscape so that the actions that they take are different is an entirely different thing. Typically what happens when a trader is violating their plan or breaking the rules in some way is that they'll consider it to be a distinct problem. For example, the trader that exits the winning trade too soon will think they have a problem with exiting trades too soon. And they'll often attribute the root cause of that action, of jumping out of the trades, to an emotion. So they might say, I feel fearful when I'm in a winning trade and I'm anxious about banking profit, and not losing the profits that I've banked to a certain point. So I jump out. So they'll see the emotion as the issue that needs to be addressed. But what happens when you approach problems, trading psychology problems, in this way is that you end up playing whack-a-mole, because you're never actually really addressing the root mechanisms, so the psychological mechanisms that are producing the emotion that cause you to take the action of violating your plan. Each time you manage to iron out one violation, another violation will pop up in some other part of your trading. You're spending your whole time applying surface level solutions to address the symptoms instead of cutting the problem off at the root. You're repeatedly bashing the moles on the head instead of just switching the machine off. We need to go a bit deeper to understand what's happening at the psychological level that results in you taking the action of violating your plan, because that is actually the symptom of this chain of events that's happening each time you break your rules, regardless of the manner in which you're breaking them. Aaron Beck's cognitive model explains this really well. At the surface observable level, we have the action of you violating your plan in whatever way that happens, whether it's taking sub-quality setups, ignoring stops or removing them altogether, going past your daily loss limit, holding on to the losing trade past the point where you should have exited. That's all behavior that's observable. But one step below that, as we've just discussed, is that there's an emotion that's driving that action. And that emotion in trading could be something like fear, greed, FOMO, anxiety, even rage, where you want to revenge trade and get back at the market. But the story doesn't stop there. Prior to that emotion being evoked, there's a thought process that's happening that is giving meaning to whatever is happening in the market to you. So you're interpreting neutral events, a losing trade, the market turning against you. At some level, you're interpreting those events and giving them meaning. And it's the meaning that you're ascribing to those events that creates the emotion that causes you to break your rules. And the thought process, so the conscious thought process that's happening, is influenced by deep subconscious core beliefs. And these are outside the level of our conscious awareness. So when you're sitting there at the trading desk and you're pressing the keys and you're taking your trades, you're not conscious of what limiting beliefs or patterns are present in you since childhood. They're usually formed in childhood and that are driving your trading. So Beck explains how a core belief can create a thought process that causes you to interpret neutral information in a way that produces an emotion that's not so helpful to you in your trading, and that emotion then primes you to take the action of violating your plan. But let's make this much more concrete and use a specific example. Here we have the example of holding onto a losing trade for too long. That's the observable action that can be measured. And then prior to that, you have an emotion. And in this case, in this example, it could be an emotion like shame, frustration, or anger that causes you to hold on to the trade. So you absolutely want to avoid losing at all costs because it's shameful, because you feel like it, has some judgment on you as a trader. We'll talk about those aspects in a second. But whatever the underlying process is, it creates an emotion that's uncomfortable and that results in you taking the action of holding on to the losing trade. The thought process that might be going on. So these might be conscious thoughts. You might be aware of them. I have to win at all costs. So perhaps you've learned that at the subconscious level, my self-worth depends on achievement. Or you've grown up in a family where you earned love through achieving and being right. So all of that, the actual winning of the trade, the being right, makes you feel safe and secure. That's not something that your conscious mind is going to be processing when you're sitting there at the trading desk. But if it's happening at that deep level, the subconscious level, it's for sure going to be driving your trading. So in this example, the conscious thought is I have to win. And the subconscious driver of that, the deep core belief that was shaped in childhood, is something like my self-worth depends on achievement. And so we can see when we consider plan violations from this perspective, we can see how the act of, being indisciplined, not sticking to your plan, is literally the tip of the iceberg. And there's all of these other factors going on underneath that have to be addressed if you want to be disciplined. And that's why saying something like just become a more disciplined trader is useless as advice. It doesn't address any of these other underlying mechanisms. Now let's look at each of those examples of the kind of generic advice that I mentioned at the start of this video and put them into this model. So we can see where they fall short very specifically. So the guidance of follow your process, of course it's right. You want to follow your process and not be focused on the P&L. But how do you actually change your behavior so that you follow through on that action? Because that's just the observable action tip of the iceberg. And we can see that follow the process on its own as a piece of advice is not sufficient because it literally only focuses on that end of the model. Then we have become a more disciplined trader. And like we just said, yes, discipline is great. It's important to be disciplined, but that on its own is not sufficient to stop you from revenge trading and blowing past your daily loss limit. Why? Because again, it only focuses on the actions. It's telling you to take a specific action. But if it was that easy, you'd already be doing it. Then we have removed decision making with defined rules. And this is like good advice. It's just not sufficient to be able to help you to stick to your plan. It's nearly prerequisite. I would assume that any trader who's operating at a high level will have a very well-defined set of rules. You'll have included a lot of if this, then that statements in your rules, in your strategy. You should know exactly what you should be doing in such a way that you can actually measure whether you executed against that. So yes, having clear rules is helpful to reduce the cognitive load in the moment of taking a trade. So you're not sitting there in the trade saying, should I do this or do that? There's a very clear plan of what you're supposed to be doing. But as we know, that's not enough to make you do it. Otherwise, every professional trader, every experienced trader who has a very good and well-defined plan would be sticking to it. And that's not the case. So in our model, we can see that this piece of advice addresses the actions part and also the plan, which I've just put outside the model because, it's not included in this model. And I'm saying that that's something that should be taken care of well before you're ever really deeply looking at your psychology. So again, it's not that it's wrong, it's just not enough. Manage your emotions. Now we're getting somewhere. Now we're getting a little bit deeper into the psychological mechanisms as to why the violation is occurring. But again, it's only halfway through the model. You've addressed the actions and you've talked about the emotions and trying to stop the emotion from arising or manage the emotion, but you're ignoring the thoughts and the limiting subconscious beliefs or the core beliefs that actually created that emotion in the first place. This is where our whack-a-mole analogy comes in. If you're just trying to address emotions and either suppress them or reduce the intensity of them by focusing on the emotions themselves, that's where you're just taking out your hammer and whacking the moles. And then you have reframe your thoughts. And according to this model, this is probably the best piece of advice out of the list that we're looking at because it actually incorporates 3 of the different parts of the process through which plan violations are triggered. You're getting right down as far as your thoughts. So you've looked at the actions, you've looked at the emotions that create the actions, and you've looked at the thoughts that evoke the emotions. But you're still missing that deeper piece, which is the limiting subconscious beliefs, the subconscious mind's influence on your trading. And if you're a serious trader, you're an experienced trader, and you want to really fulfill your true potential in trading and make the amount of money that you know it's possible to make from your strategy, you can't ignore the influence of the subconscious mind on your trading. But then there's another issue that compounds all of this. So you might be a trader who all of this is going on for, but you're operating at a low level of pressure so that it doesn't actually get activated. So it's like there's a threshold after which, if you cross that level of pressure, this chain of events gets activated, and you might get away with it until you cross that threshold. A great real-life example of this is when a trader starts on sim, they're doing really well, they're highly profitable on sim, and suddenly they go live, and the pressure has increased, and where they had zero psychology issues up to that point, they all start coming out of the woodwork. And the problem is that pressure has been introduced into the mix, and then this has triggered this chain of events. You also see it in traders who make it through prop firm challenges, and suddenly they have a live account and they're trading completely differently to how they traded on the challenges, because the level of pressure and the amount of money to lose is now suddenly very real. So pressure exacerbates or magnifies this whole chain of events. Aside from making it much more likely that whatever subconscious beliefs that are not supportive of your trading are going to get triggered and cause you to break your plan, pressure influences your execution in other ways too. There's a whole body of scientific research that focuses specifically on how pressure affects performance. That's what I actually conducted research on in relation to golfers when I was doing my sports psychology masters. So how does pressure in itself trigger execution drift? Number one, when you're feeling under pressure, your attentional focus narrows. And this is a really well-proven phenomenon. So in trading, if your attentional focus is narrowing, it means you're going to miss key signals in the market. You may even miss when your setup appears because you're actually not spotting it. Number two, pressure causes you to do the exact opposite of what you intended to do. And this is known as ironic effects. If you have a history of exiting winning trades early, it's become a big issue that you're focused on, and you're sitting there as you enter the trade and you say, don't exit the trade early. Whatever you do, don't exit this early. Pressure, when that's thrown into the mix, is going to cause you to do exactly that, the thing that you're focusing on avoiding. It also causes paralysis by analysis. So when you're doing some skill that comes so easily and effortlessly to you, it's very fluid when there's no pressure present. And then you introduce pressure into the mix, you start overthinking the execution of the skill, and then your performance degrades. So a great example of this outside of trading would be learning to drive. You get it all together, you're able to listen to the radio, have a conversation while you drive the car, you're driving safely. But then you put yourself in the driving test situation, the pressure increases, and suddenly you're overthinking everything down to, when do I press the clutch? And you can't have any other distractions or you lose focus. It's the same in trading. Paralysis by analysis in trading could stop you from entering a position. The setup appears, you've no reason to doubt it, and suddenly you start overthinking. Is this really my setup? Has it fit all the criteria? I think the market's going to do something else. Maybe I should wait for the next setup. And suddenly you haven't even taken the trade. Another example of how pressure impacts performance is that it reduces the efficiency of your cognitive processing. So this means that while you might actually arrive at the same good conclusion when you've gone through your decision-making process, the actual decision-making process takes longer and it's much more effortful. And in trading, when split-second decisions can make or break the trade, that means that you might hesitate on an entry so that you enter at a, not an optimal time. You've kind of missed the setup occurring. Or maybe you don't exit the trade on time. So you're dithering about whether you should stay in or take profits or whatever it is, and then, you miss the exit. Pulling it all together, this is a model that I've created to explain the psychological mechanisms that are happening when you're violating your trading plan. And this is regardless of what type of violation you're engaging in. If you're removing stops, if you're going past your daily loss limit, if you're FOMOing into low quality trades, whatever action you're taking that reflects you breaking your rules, this is what's going on underneath in every case. There's limiting subconscious programming. So your subconscious mind is programmed with core beliefs that are not supportive of you executing your plan. So for example, I have to succeed in order to have self-worth. That's sitting there latent. Then you introduce pressure to the mix, and that triggers the subconscious program, which then starts influencing your thoughts, your emotions, and your actions. The pressure itself elicits a stress response. So maybe you're someone who freezes under pressure. You just go completely like a deer in headlights and you stop actually executing any trades. You don't take any trades. Maybe you're somebody who goes into the fight reaction under stress. And so you take tons of trades. You're trying to trade your way out of the loss. Or you could be somebody who numbs under pressure, and because you become completely numb to the consequences of your actions, it allows you to keep trading past your daily loss limit. So we all have ways that we cope with stress, and those coping mechanisms also can be a hindrance to our trading. They get activated. And then when you throw in cognitive biases and, habits that don't support performance, so these are things like the victim mentality, the market's out to get me, even just a bias for always going long. When we add these to the mix, these magnify the impact of the subconscious beliefs and pressure on trading. And when you combine all of those things together, it's a recipe for disaster. It results in inconsistent execution. So inconsistent execution, or violating your trading plan, is the consequence of these three factors all interplaying together. And so the fix has to account for each of these factors individually and the way that they all interrelate to produce inconsistent execution. And again, we can see why those very surface level suggestions as to how to stick to your plan just can't cut it. None of them speak to the level of complexity and depth that we're talking about here. So they're not actually getting right down to the root cause. They're whacking the moles on the head, but they're not switching off the machine. But this is why we can actually take a proactive, preemptive approach to inconsistent execution. If we know that as humans, all of this stuff is likely to happen when we're in a pressured arena like trading, we can preemptively create a solution and train ourselves to reliably execute under pressure. We don't have to wait until we've lost loads of money in the market to realize that there's a problem. We can predict that because we're human and because psychology operates in this way, it's likely going to impact our performance, and therefore we intervene before it ever does. In the reactive approach to a trading plan violation, you wait till the violation is repeatedly occurring. So it occurs once, you don't think something of it. You wait until it's happening again and again and again, and you're losing lots of money, or you're giving back so much money to the market that it's becoming very painful. And then you think, okay, now I really have to do something about it. The P&L has already been impacted. In the reactive approach to trading plan violations, you consider the violation as an isolated problem with a single solution. And as we've just described in depth, this just isn't sufficient. If the solutions you're using are not fit for the job, they're not going to fix the problem, and you're going to continue losing money while expending energy. It's much better and much more profitable to take a risk management approach. It doesn't matter who you are, how long you've been trading in the market, because you're a human, these factors are going to influence your execution, and they're going to do so for the entirety of your trading career. So you proactively optimize each of these factors before any violations occur. If we view it through the lens of risk management, then we take a systematic approach to conditioning every single element that impacts your execution. So your subconscious beliefs, you're rewiring those. You're figuring out what ones don't serve you, and you're consciously rewiring them to support your trading. You're looking at how you respond to stress, and then you're optimizing that so that you don't freeze or go numb or take flight under pressure, so that you're able to stay grounded and present with your trading. Just like an athlete will condition every aspect of their body in a plan that's tailored to the type of actions that they're supposed to be taking on the pitch or in the arena, you can do this for your own psychology. And then we understand that, again, because we're human, there will be slip-ups. But when you take this risk management, proactive, systematic approach to conditioning your psychology, you're going to minimize the magnitude of any rule violations, you'll minimize the duration of those violations, and most importantly, you'll minimize the impact. Yes, they might happen, but if you can quickly recover and reset to neutral after the first losing trade, that's a completely different picture for your P&L than if you go into a drawdown and you spiral into plan violation after plan violation and your execution drifts very far from where it's supposed to be. This all sounds great in theory. You may understand, okay, I'm on board with taking a risk management approach. I want to take a systematic approach to conditioning my psychology. I see how this can save me money or make me money in the market. But how do I actually do that? This is why I created my Go Deep to Level Up mental conditioning protocol for traders. It's an evidence-based, science-backed protocol that systematically addresses every single element of your psychology that influences your execution under pressure. It draws on the science of sports psychology, performance psychology, and behavior change. It's a two-phase protocol. The first part of the protocol is tailoring it specifically to you and your context, including adapting the tools and techniques that we use to influence our psychology to your specific scenario and context. It's no use using somebody else's affirmations that speak to subconscious limiting beliefs that they have if those are not present for you. So it's really important that every aspect of the protocol is mapped onto you and your trading. But the protocol is constructed in such a way that it's very possible and easy to do this. Then the second part is actually implementing it. So the practicing of your mental conditioning routine day in, day out, week in, week out in your trading. Think of this like an athlete who is getting a really good strength and conditioning program from an S&C specialist. They will work with the specialist to adapt a protocol specifically to them and their athletic goals. But then if they never actually go and do the strength training, it's not going to have any impact on their performance on the pitch. They have to actually turn up in the gym and implement the program to see any results. And it's the exact same here. If you only do the tailoring of the protocol to you and you never actually practice it, nothing's going to change. And if you take it at the generic level, you never tailor it to you, and then you practice that week in, week out. So, for example, taking generic affirmations off the internet, it's probably not going to make as much of a difference to your execution of your trading as the personalized version. Really importantly, this protocol includes troubleshooting. So you can start it if you're already experiencing trading plan violations and you want to improve that. But you could also start it at the level where everything's going well and you want to optimize things and kick it up a level. I'm about performance enhancement, and that doesn't mean that something has to be going wrong in order for you to get a few notches better at your trading performance. This protocol addresses both. And if you are currently really suffering from inconsistent execution, it will help you to resolve that. And then you'll keep using the same protocol to keep taking your performance to that higher and higher level. It's the same protocol that works for both troubleshooting and optimization. It's designed to be integrated into your trading routine. So once you've done all the work to customize it to you, the actual implementation piece doesn't take that long. It's something that becomes a habit. It's become second nature. As much as you're probably already doing some journaling when you finish your trading, or maybe you have some element of pre-market preparation that you go through every day, this becomes a similar habit or routine that's integrated into your trading. It's not abstract. It doesn't require reading trading psychology books every week or continuing to keep up with trading psychology videos. It's just a simple action plan that you just get into a habit of implementing in your trading all the time. And finally, this protocol has been proven time and again by experienced and professional traders. And that's both at the one-to-one level, where I have worked one-to-one with traders to help them create their own plan and implement it in their trading, and then also at the self-driven level. I have an option of learning this protocol, applying it to your trading context, and implementing it in your trading, where it's completely self-driven. So that's my Go Deep to Level Up Your Trading self-driven program, which is available on my website. So the protocol is the same and it's just deployed in different formats. It can also be used at a scalable level with trading firms and institutions. To give you an idea of the types of results that people have gotten by using this protocol, Francois Gerber was a hedge fund manager who hit a Sharpe ratio above 2 when he used this protocol to help him break through an asset threshold ceiling. Malene Sheth, who was an experienced trader and had a trading company himself, went from taking 75% of A+ setups to 100% of A+ setups within 6 weeks of starting this program. And in the same time frame, he improved on following his trading process on 61% of trades to following it on 93% of trades in just 6 weeks. John Turnbull saw an improvement in execution of his trades in an even shorter time frame. He went from 14% planned trades to 100% planned trades in just 4 weeks. Now, I'm not guaranteeing fast results, but the protocol works with where you're at currently. If you're someone who's never looked at psychology in depth, you've never implemented any mental conditioning techniques in your trading, it can work for you. And then at the other end of the scale, if you're someone who had already reached consistent profitability, as in the case of John Turnbull, he had been doing really well, and then he said he became complacent. It was nearly just happening on autopilot, and that's where his indiscipline kicked in. So he was able to experience faster results with it because he already had that bank of experience of being consistently profitable and doing things right, but he had strayed very far from that path. So the protocol set him back on the right path, and then it enhanced his trading overall. So to recap, we've explained why trading plan violations happen, the science behind it. We understand the depth that's involved and the complexity that's happening underneath the surface when you are breaking your rules. And we understand why that requires a risk management approach. And then finally, if this is something that you actually want to take action on right away, there is a proven mental conditioning protocol that can help you to optimize every single aspect of your psychology that influences your execution under pressure. If you want to learn more about the Go Deep to Level Up protocol and how it might help your trading, you can check out the self-driven version. So this is available at all times on demand. You can just purchase it on my website. That's available on creativeperformance.com/level up. So all of the information is there. Or if you're a professional trader who's looking to engage in a 14-week consulting container that offers very in-depth personalized support and accountability, then you might like to check out my one-to-one consulting container. So that's createaperformance.com/one-to-one traders. Or if this is resonating, but you still have questions, you're not quite sure if this protocol is the right next step for you in your trading, or maybe you're not sure what format is most suitable for you, then you can apply to book a program fit call with me on Zoom. So this is a 30-minute, no obligation consultation, totally complimentary, where we discuss your trading challenges and goals, and I can help you understand how the protocol could help, if it can, and what format might be best for you. There is an application form for this call because the protocol isn't the right fit for every single trader, and also my time for these calls is limited. That's what I have for you in this video. Thanks for watching, and I look forward to seeing you in the next one.